All right, welcome to The Explainer. Today we are diving into a topic that can get, well, a little tricky. We're talking about UK inheritance tax, and specifically what happens when you and your siblings are inheriting an estate together. So let's get right into it. Look, we all know that sorting through a loved one's will it's just a really tough time. And then you've got inheritance tax, or IHT, which can feel like a total minefield on top of everything else. But here's the thing. There's a very specific tax trap that catches siblings out time and time again. So in this explainer, we're going to break it down step by step so you know exactly what to watch out for. Okay, so first things first, let's get the basics down. What is inheritance tax really? And how does it all work for the 2025/26 tax year? Let's cover the ground rules.
So, what actually is it? Well, put simply, inheritance tax is a tax on a person's entire estate. And when we say estate, we mean everything: the property, the money, the possessions, the whole shebang. The really important thing to get your head around is that this tax is taken before anyone, including you and your siblings, gets a penny. HMRC gets their slice of the pie first.
Okay, here's the first number you absolutely need to remember. Every single estate gets what's called a nil rate band. Think of it as a tax-free allowance. That amount is £325,000. So the first £325,000 of an estate, completely tax-free, nothing to pay on that. But what about everything over that £325,000 mark? Well, that's where it gets serious. It's taxed at a whopping 40%. Yeah, 40%. And you can see why. With property values going up and up, this is catching more and more families in its net. Right, and this brings us to the real heart of the matter. This is why we're doing this explainer. There's a specific, kind of hidden disadvantage that hits siblings especially hard. It's a little detail in the rules that we're calling the sibling tax trap.
Okay, check this out, because this is where everything changes. Everyone, and I mean everyone, gets that standard £325,000 allowance we talked about. But if you're a direct descendant, so a child or grandchild, you can get another £175,000 tax-free on top of that if you're inheriting the family home. It's called the Residence Nil Rate Band. But, and here's the trap, siblings, you don't qualify for it at all. Your tax-free limit stays firmly capped at that £325,000.
And the financial hit from this? It's huge. Just think about it for a second. Let's say a parent's estate has a house worth £400,000. If their kids inherit it, they could potentially pay zero tax. But if the siblings inherit that exact same house from, say, another sibling, they're suddenly looking at a tax bill on £75,000 of that value. It's this one rule, this one little distinction that is dragging thousands of families into paying inheritance tax.
So how does HMRC actually work out the bill? This is super important. The tax is calculated on the total value of the estate first. It happens before a single pound is divided up between you and your siblings or any other beneficiaries.
The calculation itself is actually a pretty simple four-step process. Step 1, you add up the value of everything in the estate. Step 2, you take away any debts. Think mortgages, loans, funeral costs. Step 3, you subtract that £325,000 tax-free allowance. And then step 4, whatever's left over, that's the amount that gets hit with the 40% tax. Simple as that. That's the bill the estate has to pay.
Okay, let's put some real numbers on this. Take the story of the Manchester siblings. Their mother's estate was valued at £600,000. So you take that, you subtract the £325,000 allowance, and you're left with £275,000. Now you apply that 40% tax rate to it, and bam, that's a £110,000 tax bill. So the pot of money the three siblings thought they were sharing, that's £600,000, it instantly shrank to £490,000. That's a huge difference.
But of course, it's rarely ever just that simple, right? That basic calculation is just the beginning. So now, let's get into some of the other common complications that can really trip families up. We're talking about things like past gifts and family businesses. One of the biggest ones is what's known as the 7-year gift rule. Basically, if the person who passed away made any large gifts in the 7 years before they died, that money can still be counted as part of their estate for tax purposes. Now, the tax rate does taper down over time, so a gift made 6 years ago is taxed a lot less than one made 2 years ago. After 7 full years, it's totally tax-free. But here's the warning. A really big gift made just a couple of years before death could use up that entire £325,000 tax-free allowance, leaving the rest of the estate completely exposed to that 40% tax rate. Now, what if there's a family business or a farm involved? Well, this is where some really powerful tax reliefs can kick in. There's something called business property relief, or BPR, and it can literally slash the tax on business assets, sometimes all the way down to zero. But, and this is a massive but, HMRC is incredibly strict about this. The business has to be an actual trading business, not something that just holds investments, like a portfolio of rental properties. That's a key distinction that trips a lot of people up.
All right. I know we've thrown a lot of information at you, so let's take a breath and pull this all together into a simple, actionable plan. These are the key things you really need to remember for your family.
Okay, here it is, your 5-point IHT checklist. Number 1, know the core numbers. It's 40% tax on anything over £325,000. Got it? Good. Number 2, remember the sibling trap. You do not get that extra $175,000 home allowance. That's a big one. 3, dig into the last 7 years. Look for any large gifts that might affect the tax bill. 4, unequal shares don't matter for the tax man. The total tax bill on the estate is the same, no matter how you slice it up afterwards. And finally, number 5, verify everything. Seriously, double-check all of HMRC's calculations. Mistakes are common, and they can be costly.
And that really brings us to the final and maybe most important question. Now that you have this knowledge, is your family actually ready to have the IHT conversation? Because trust me, planning ahead and getting on top of these rules won't just save you a ton of money, it'll save you an incredible amount of stress and heartache down the road.